Let me give you a figure that'll blow your mind, I think. I bought my first stock when I was 11 years old. Three shares, 114.75. If I put that 114 into the S&P 500 at that time, think of a figure as to what it would be worth today.
Oh, man.
Well, the answer is about $400,000. Oh. So if I, as a little kid, had taken that $114 I'd saved shoveling snow or whatever I'd done, $400,000 today, one person's lifetime.
He's considered the Michael Jordan of the investment world. Being the single most successful investor in the last century, his net worth is now over $80 billion. And it all started when he bought his first stock at 11 years old.
So would you please give a very warm welcome to the Oracle of Omaha, Warren Buffett.
Testing. 1 million, 2 million, 3, okay.
Hey everyone, welcome to today's episode of Truth Leaders, where today we're going to learn about Warren Buffett's top 10 guiding principles that's led him to his success in business and in life. Let's go.
Warren Buffett has been a long believer of buying value-based stocks. It's not the price that matters, it's the value.
Well, again, I love it when the things we buy go down. I get euphoric, stocks are down today and I'm buying more of something I was buying yesterday. I'm buying it cheaper. People with their stocks, they think that the stock knows more than they do. So that when the stock goes down, they say the stock is telling them something, and what's telling me is I can get more for my money. but they take it as kind of a referendum on themselves, and it's me versus the stock. If it ever gets back to what I paid, I'm going to sell it. The stock doesn't care what you paid. You have to remember, the stock doesn't even care that you own it. You are nothing to the stock. That stock is everything to you, And you remember you paid $10.13, and therefore the stock should get to $10.13 before you sell it. The stock has no feelings about you. I hate to disillusion you on this, but it just doesn't care. And so the only question with every stock, every day, and you don't do it this frequently, is, can I get more for my money someplace else? You've got a chance to be in thousands and thousands of great businesses, and their prices change all the time, so their relative valuations change. And you can make the exchange at very low cost these days. Commissions are nothing. So you can always shift from one business to another. You have a huge advantage over Andrew Carnegie. When he was in the steel business, he was in the steel business, or Rockefeller was in the oil business. He could not shift over immediately to retailing or something like that. You can rearrange your business empire, which you own through that little portfolio that you have. You can rearrange that, at a moment's notice with practically no cost. It's a huge advantage, which people turn into a disadvantage. There is nothing about the price action of the stock that tells you whether you should keep owning it. What tells you whether you should keep owning it is what you expect the company to do in the future versus the price at which it's selling now, compared to the other opportunities of businesses that you think you know equally well, and make that same comparison. And that's all there is to owning stocks.
Making decisions on stocks isn't always easy. Warren's first advice is to know the difference between investing versus gambling.
There's two kinds of items that people buy and think they're investing. One really is investing and the other isn't. If you buy something, a farm, an apartment house, or an interest in a business, and look to the asset itself to determine whether you've done something, what the farm produces, what the business earns, and so on, you don't really care whether the stock market's open. You can do that on a private basis. In fact, you do it on a private basis if you buy a farm or apartment house generally. And it's a perfectly satisfactory investment. You look at the investment itself to deliver the return to you. Now, if you buy something like Bitcoin or some cryptocurrency, you don't have anything to produce anything. You're just hoping the next guy pays more. And you only feel you'll find the next guy to pay more if he thinks he's going to find somebody that's going to pay more. Now, if you ban trading in farms, you could still buy farms and have a perfectly decent investment. If you ban trading in apartment houses or even in equities. If you ban trading in Berkshire Hathaway for the next 5 years, our investors would do fine, over time. But if you ban trading in tulip bulbs, or if you ban trading in some Bitcoin, which nobody knows exactly what it is, people would say, well, why in the world would I buy it? Yeah. And you aren't investing when you do that. You're speculating. There's nothing wrong with it. If you want to gamble, somebody else will come along and pay you more money tomorrow. That's one kind of game. That is not investing.
Interesting.
In investing, Warren explains that the biggest mistake is not making mistakes, rather, it's not seizing opportunities when you know it's right.
But the biggest mistakes we've made by far, I've made, not we've made, biggest mistakes I've made by far are mistakes of omission and not commission. I mean, it's the things I knew enough to do, they were within my circle of competence, and I was sucking my thumb. And that is really, those are the ones that hurt. They don't show up anyplace. I probably cost Berkshire at least $5 billion, for example, by sucking my thumb 20 years ago or close to it when Fannie Mae was having some troubles, and we could have bought the whole company for practically nothing. But I did know enough to understand Fannie Mae, and I blew it. And that never shows up under conventional accounting. But I know the cost of it. Omission is way bigger than commission. There's big opportunities in life have to be seized. We don't do very many things, but when we get the chance to do something that's right and big, we've got to do it. And even to do it in a small scale is just as big a mistake almost as not doing it at all. I mean, you've really got to grab them when they come, because you're not going to get 500 great opportunities.
How do you know when it's the right investment? Well, Warren shares that you have to focus on your strengths, and that will lead you to success in something he calls the circle of competence.
Defining your circle of competence is the most important aspect of investing.
The most important thing is to be able to define which ones you can come to an intelligent decision on and which ones are beyond your capacity to evaluate. You don't have to be right about thousands and thousands and thousands of companies. You only have to be right about a couple. I met Bill Gates on July 5th, 1991. We were out in Seattle, and Bill said, you've got to have a computer. And I said, why? And he said, well, you can do your income tax on it. I said, I don't have any income. Berkshire doesn't pay a dividend. He said, well, you can keep track of your portfolio. And I said, I only have one stock. I said, and he says, it's going to change everything. And I said, well, will it change whether people chew gum? And he said, well, probably not. And I said, well, will it change what kind of gum they chew? And not. And I said, well, then I'll stick to chewing gum and you stick to computers, I don't have to understand all kinds of business. There's all kinds of business I don't understand. But there's thousands of opportunities there. Ted Williams wrote a book called The Science of Hitting. And in The Science of Hitting, he's got a diagram, shows him at the plate, and he's got the strike zone divided into 77 squares, each the size of a baseball. And he says, if I only swing at pitches in my sweet zone, which he shows there, and he has what his batting average would be, which is 400. If he had to swing at low outside pitches, but still in the strike zone, his average would be 230. He said the most important thing in hitting is waiting for the right pitch. Now, he was at a disadvantage because if the count was 0-2 or 1-2 or so on, even if that ball was down where he was only going to bat 230, he had to swing at it. In investing, there's no called strikes. People can throw Microsoft at me and, you name it, any stock, General Motors, and I don't have to swing. And nobody's going to call me out on called strikes. I only get a strike called if I swing at a pitch and miss. So I can wait there and look at thousands of companies day after day, and only when I see something I understand and when I like the price at which it's selling, then if I swing, if I hit it, fine. If I miss it, it's a strike. But it's an enormously advantageous game. And it's a terrible mistake to think you have to have an opinion on everything. You only have to have an opinion on a few things. In fact, I've told students, if when they got out of school, they got a punch card with 20 punches on it, and that's all the investment decisions they got to make in their entire life, they would get very rich because they would think very hard about each one. And you don't need 20 right decisions to get very rich. 4 or 5 will probably do it over time. I did form an opinion, on the Bank of America, and I form an opinion on Coca-Cola. I mean, Coca-Cola's been around since 1886. There's 1.8 billion 8-ounce servings of Coca-Cola products sold every day. Now, if you take 1 penny and get 1 penny extra, that's $18 million a day. And 18 million times 365 is 7 billion, 3 less 730 billion, or $6,570,000,000. So annually, $6,570,000,000 from 1 penny. Do you think Coca-Cola is worth a penny more than, Joe's Cola? I think so. So, and I've got about 127 years of history that would indicate it. So those are the kind of decisions I like to make. And you may have an entirely different field of expertise than I would have, and probably much more up to date in terms of the kind of businesses that we're seeing evolve. And you can get very rich if you just understand a few of them and understand their future.
Buying a stock is buying a company, or at least part of it. After you choose the right one, commitment will bring you more and more value through the years.
In terms of our wholly owned businesses, we're not going to sell no matter how much anybody offers us for them. I mean, if somebody offers us 3 times what something is worth at See's Candy, the Buffalo News, Borsheim's, whatever it may be, we're not going to sell it. Break off relationships with people I like and people that have joined me because they think it's a permanent home. To do that simply because somebody waves a big check at me would be like selling one of my children because somebody waved a big check. So I won't do that. And I want to tell my partners I won't do it so that they're not disappointed in me. More and more, with certain stocks, we've got that approach. Now, if we were chronically short of funds and had all kinds of opportunities coming, we might have a somewhat different approach. But our inclination is not to sell things unless we get really discouraged perhaps with the management, or we think the economic characteristics of the business change in a big way. I mean, and that happens. So, but we're not going to sell simply because it looks too high, in all likelihood. I mean, you can't make that 100%, but that's the principle under which we're operating. We're generating right now $5 billion of cash a year at least. So it's $100 million every week. And, just that we've been talking here half an hour and I haven't done a damn thing. It's, the real question is how do you put it out intelligently? And if we were selling things, it'd be just that much more.
In the stock market, there is success with patience. Warren will tell you that dabbling and going outside your circle of competence can lose you money.
I bought a book in 1949 by a fellow named Ben Graham called The Intelligent Investor. I don't remember what I paid. But aside from what I paid for my 2 marriage licenses, that was the best investment I ever made. It's very important to have the right framework. Stocks sell at silly prices from time to time. Most stocks at one time or another sell at very silly prices. And it doesn't take a high IQ to figure out that they're cheap, but it does take a temperament that's willing to step up and actually act. I tell people, if they're going in the investment business, if you got 160 IQ, sell 30 points to somebody else because you won't need it. I mean, I figured out very early, you don't have to be that smart in this business, which is fortunate, but you do have to have the right temperament. And you have to be able to ignore what other people are saying and simply look at the facts and decide, is this stock which is selling at X worth 2X? And occasionally you'll find things like that. And when you don't find them, you don't do anything. So,
there will be times when we all make mistakes. Warren Buffett explains the best way to handle it.
the worst investment I ever made? How long do you have? I've made some very bad ones, but that doesn't really bother me. It may bother the shareholders, but that's another question. You're going to make mistakes in life. I mean, there's no question about it. You don't want to make them on the big decisions, who you marry and some things like that. So there's no way I'm going to make a lot of business and investment decisions without making some mistakes. I may try to minimize them. I don't dwell on them at all. I don't look back. The biggest mistakes are the ones that actually don't show up. They're the mistakes of omission rather than commission. We've never lost that much money on any one investment.
but it's the things that I knew enough to do that I didn't do. We have missed profits of as much as, maybe $10 billion in things that I knew enough to do and I didn't do. Now, the fact I didn't buy Microsoft way back is not a foregone opportunity because I didn't know enough to make that decision. But there have been other investments where I did know enough to make the decision, and for one reason or another, I either didn't do it at all or I did it on a small scale. I was sucking my thumb when I should have been writing checks, basically. And those don't show up. There's no place where it shows missed opportunities, but I've missed some big ones. The triumphs in life are partly triumphs because you know that everything isn't going to be a triumph. And I would never get too hung up on mistakes. I know a lot of people that really agonize over them, and it just isn't worth it. I mean, tomorrow's another day, and you live it forward and just go on to the next thing.
Thank you so much for watching today's video. These videos are made for anyone looking to create their own path. So if you'd like to see another masterclass on someone else, go ahead and let me know in the comment section below, and we'll see what we can do. Finally, I'd love to give a shout out. Thank you so much for being a new subscriber and leaving that comment. I appreciate it more than you know. And lastly, I just want to thank you again for watching today's video. A change is a-coming, and it's inside of you. So keep going, and I'll see you in the next video.
And you want a marriage that's going to last. Not necessarily the happiest marriage, or one that Martha Stewart will talk about or anything, but you want a marriage that's going to last. What quality do you look for in a spouse? One quality. Do you look for brains? Do you look for humor? Do you look for character? Do you look for beauty? No. You look for low expectations. That is the marriage that's going to last. Both have low expectations. And I want my partners to be on the low side on expectations coming in.
Click or tap on the like button if you found value in this video, and if you'd like to learn more about investing, go ahead and click or tap right here, or click or tap right here for another money-making video. I'll see you next time.